What I'm telling you in a very long-winded fashion is that if past is prologue, the US government will have to do again to the purchasing power of the dollar what they did in the decade of the 1970s. And it is likely to me that the financial asset that people will turn to as a consequence of the deterioration of their purchasing power in US dollar savings will be gold. I'm not saying, by the way, that silver is going to run anytime soon. I think that gold will for a while continue to outpace silver. But if I were to speculate on which commodity has the best chance of doubling, that would be silver.
Gold prices reached a new record on Monday, surpassing $2,630 per ounce, as investors increasingly anticipate a November interest rate cut by the U.S. Federal Reserve. This surge in gold prices comes amid a broader debate about inflation and monetary policy in the United States. RickRule, founder of Sprott Global Resource Investments and a renowned expert on resource investments, has long warned that the U.S. might resort to inflation to reduce the present value of its obligations. Rule argues that this approach could drive more investors towards gold as a store of value against declining dollar purchasing power. The Federal Reserve's recent decision to cut interest rates by 0.5 percentage point has sparked intense discussions among central bank officials. While one governor argued that weak inflation justified the substantial rate cut, another contended that persistent price pressures warranted a more modest reduction. This internal debate reflects the complex economic landscape facing policymakers. As traders brace for potential rate cuts, the U.S. dollar has edged lower against major currencies. This weakening typically boosts the appeal of gold and other precious metals as alternative investments. Silver, often considered gold's more volatile cousin, has also seen gains. Silver prices rose to $30.87 per troy ounce on Tuesday, up 0.56% from Monday's close. The gold-silver ratio, which indicates the relative value of the two metals, decreased slightly to 85.15, suggesting a marginal outperformance of silver compared to gold. Rule sees the potential for silver to rise significantly if general investors enter the market. However, he cautions against expectations of a short-term surge in silver prices. The precious metal has lagged behind gold in recent years, partly due to substantial gold purchases by central banks. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I am afraid, honestly afraid, that gold will go much higher. I don't own gold because I think it'll go from 2,500 to 3,000.
Exactly.
I own gold because I'm afraid it'll go to 9 or 10,000. Is this a prediction? No, it's a fear. But let me give you the math, not the narrative behind the fear. The U.S. economy, and I'm a U.S. citizen, so of course I'm U.S.-centric. The U.S. economy is 23% of the world savings and investment market. While the U.S. is becoming less prominent, it's still hegemonistic. And the arithmetic around the U.S. economy is scary. At the federal level, our on-balance sheet liabilities exceed $35 trillion. But much more scary than that is the net present value of our off-balance sheet liabilities. Unfunded Social Security, Medicare, Medicaid, government worker pensions, military pensions. That number, not the aggregate number, not the number over time, but the net present value of unfunded liabilities exceeds $100 trillion. So the aggregate liability of the U.S. citizenry expressed by the federal government is $135 trillion negative. And that number is increasing by $2.5 trillion a year in the on-balance sheet liabilities, and recent estimates suggest $5 trillion a year in the off-balance sheet liabilities. Now, the aggregate revenues, the total revenues of the federal government are $4.6 trillion a year, which is to say that the deficit that we're incurring on an annual basis exceeds our revenues by more than 2 to 1. How do we get out of this circumstance? There's only 2 ways that I can think of. You change the nature of your payments, which is to say you means test Social Security, you reduce the benefit, you change the year that people accrue it, which will wreak real hardship in the U.S. economy. And likely, you inflate away the net present value of the obligation. What the United States did in the decade of the 1970s is via inflation, they inflated away 85% of the net present value of their obligations. They devalued the US dollar in terms of purchasing power by 85% over 10 years. That coincided with an increase in the gold price from $35 an ounce, admittedly price controlled, to $850 an ounce. What I'm telling you in a very long-winded fashion is that if past is prologue, the U.S. government will have to do again to the purchasing power of the dollar what they did in the decade of the 1970s. And it is likely to me that the financial asset that people will turn to as a consequence of the deterioration of their purchasing power in U.S. dollar savings will be gold. I think you probably look at silver. Silver hasn't kept up with gold in commodity appreciation because the buyer in the market has been a fear buyer. It's primarily been central banks. If the precious metals narrative continues to the generalist investor, if past is prologue, when the generalist investor comes into the precious metals market, they come into the silver market. I'm not saying, by the way, that silver is going to run anytime soon. I think that gold will, for a while, continue to outpace silver. But if I were to speculate on which commodity has the best chance of doubling, that would be silver. If you give me 5 years, that's a different circumstance. That's North American natural gas. It's worth $8 on world markets. It sells in the U.S. for $2.25 and in Canada for $1.50.
The 2008 financial crisis, often compared to the Great Depression of 1929, marked a pivotal moment in recent economic history. While the official start of the recession dates back to late 2007, its full impact wasn't felt until the autumn of 2008, when much of the global banking and financial system faced severe distress. During the turbulent period, gold emerged as a top performer, recovering quickly due to its unique attributes, intrinsic value and independence from other entities' liabilities. This makes gold particularly attractive in times of economic fear and uncertainty. The performance of precious metals leading up to and during the crisis was remarkable. In 2007, as the seeds of the recession were being sown, gold prices averaged nearly $700 per troy ounce, representing an impressive annualized gain of over 30%. This surge was part of a broader bull run for gold in 2001. The momentum continued into 2008, with gold prices reaching unprecedented heights. In the first quarter of that year, gold broke the psychologically significant $1,000 per ounce mark for the first time in history, setting new nominal all-time highs. RickRule further notes that the government's response to the 2008 crash inadvertently bolstered gold's appeal. Let's get back to the interview.
If the crash that you're talking about takes the form of the 2008 crash, which is really a collapse in confidence and the removal of liquidity from the market, everything goes down.
Yeah.
Because the sell decision isn't made by Lucien. It's made by Lucien's margin clerk. And he or she doesn't care what you think about an asset class. They're just looking for a bid. So if you'll recall 2008, the gold market held up for 24 hours. And then it fell apart too. They take no prisoners in that kind of war. What happens is that the most stable asset classes recover first. And if you look at the recovery of various financial markets in 2008, one of the first to recover was the gold market. Why? First of all, people go to gold in times of fear. It is an asset that isn't simultaneously somebody else's liability. You don't need to make a credit decision if you own gold. The second is that it was very obvious in the aftermath of the 2008 crash that the policy response would be to add counterfeit liquidity, which is to say to print, which obviously inures to the benefit of gold. The other asset classes that did well were very high-quality short-term bonds, secure places to put cash to ride out the storm. The third asset class that did well was the largest industrial corporations in America, the most liquid markets with the best balance sheets and the best profit margins. In other words, there was a distinct flight to quality. What didn't recover for a very long time were tertiary assets, marginal assets. Sadly, there's no more marginal asset on the planet than a penny mining share. So if we have a real market crash, asset class that your listeners are holding for maximum upside will deliver them, at least in the interim, maximum downside. And people need to understand that, which is why I ask people to have most of their portfolio in natural resources around beta, most of their portfolios around natural resources in the highest quality companies, with the most trading liquidity, with the best balance sheets, with current operating margins, and with their soundness and stability demonstrated by an earned dividend yield. I'm not saying to people, don't do what I did. I'm not saying to people, don't chase the 10 baggers, the 20 baggers, and the 30 baggers. Chase them with money that you can afford to lose. Chase them in circumstances where you are certain enough about the long-term future of the company that you can psychologically and financially weather a 50 or 60% share price decline should a bad market come.
While gold remains a favored asset due to its historical performance during crises, silver holds significant potential for long-term gains, especially if general investors re-enter the market. As the debate over monetary policy continues, investors must carefully consider positioning themselves in this ever-evolving environment. Given the historical performance of gold during financial crises and the ongoing concerns over inflation, how do you think precious metals will fare in the next potential market downturn? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.